All right, well, welcome everybody. Let's go ahead and get underway. Welcome to the February, actually the Valentine's Day edition of Dashboard Diagnostics. I think we've got a pretty good session in store for you here as we will return to our traditional monthly program of taking a look at an actual club portfolio. As we were saying a few minutes ago, we're going to stay a little bit anonymous with this one and going to refer to them as the senior stock societies. And one of the reasons I bring that up is they mentioned in their correspondence with us that they actually serve a group of investors who live in one of the retirement communities in the town in northwestern Indiana where they come from. And I don't know, I've spent a lot of time over the years working with clubs in places like Sun City, California, a little bit in Arizona, and some of the retirement communities, even in Texas and in Florida. And I just want to point out that our experience has been that this is a really nice program for the seniors to get into, and it can be a lot of fun. It can be quite a hobby for them, and we just have had just wonderful experiences with the Sun City group out in California, for instance. They won the Veteran Investing portfolio contest a few years ago, so I got to spend some time with them, and just wanted to basically make this also a tribute to those groups of seniors operating together in the clubs in those communities throughout the country. Well, it is February, so we've got Abe there, the 1909 penny there, and again, that's kind of a penny for our thoughts type thing. And then in honor of Valentine's Day and the fact that the club that we're featuring here tonight is from the state of Indiana in the Hoosiers, many of you are very familiar with my stories about Gene Hackman and the basketball team and all that kind of stuff, but I thought, and then I also kind of balance the story with the point for the ladies who get tired of us talking about sports too much, that there is a love story in the movie Hoosiers, maybe a story about a basketball team, but Barbara Hershey, as you can see there with Gene Hackman, for those of you that have or haven't seen the movie, they're both teachers, obviously, and there is a little bit of a romance there. So again, we just kind of celebrate that along with Valentine's Day.
Oh, Mark, Gene says it's a senior center. It's not a retirement community.
Okay, well, still works. Still works
Yeah.
for what we're saying. Getting together and having fun together, learning and leaning. And then the picture on the far right is actually the lighthouse and the pier near Michigan City, Indiana, which isn't too far from where many of the participants in this particular investment club hail from. And we've actually seen sunsets like that many times. That's a few miles down the road to the south from Lori's home turf there in Traverse City, Michigan, but it's got some equally powerful scenery. Let's get this out of the way before we get started. Again, we are going to be talking about real companies with a portfolio, real time, going to be expressing opinions, and everybody just simply has to know that no investment recommendation is intended whatsoever. Everything that we do here, and we're renowned for it, is done for educational demonstration purposes. So we're going to be talking about case studies, talking about companies demonstrating features that can be done, the tools at Manifest Investing. Some of the stocks could be held by Lori, myself, or people that are here in the room. We try to be as truthful as we possibly can, but we can make mistakes, and just, again, no investment recommendation is intended. Well, here's a little bit about the club. It's been around for a few years now. Founded in 2006. They actually have 23 ladies. They are willing to take up to 30 participants in the club as partners. They are in northwestern Indiana, just off the shores of Lake Michigan. And again, I just played with the name a little bit, Senior Stock Society, in honor of those seniors group all over the nation. And again, we're also going to spend some time talking a little bit about the Beardstown ladies here in a minute. We spent Valentine's Day with the Beardstown ladies over in Illinois, neighbors to these guys, a year ago. And just some powerful stuff there. Now, the track record, they have a rate of return since January 2006 of 7.3%. Now, that might not sound like much. You know, we have this goal, you know, always ingrained in us to do 5% better than the market, and then over the very long term, we try to aim for upwards of 15% per year. Well, they're only at 7.3, and that might not sound so good until you place it in the right context or the right perspective. The S&P 500 over that same time frame, and again, this is using the benchmarking feature for tracking performance, kind of a report card thing within the Bivio club accounting software, where you basically are comparing what if you had taken that money instead of investing it in the club and had invested it instead, the same amount of money, same cash flows over that time frame in the S&P 500, well, that would have earned 6.1% per year. So what we see is that actually an advantage. They're actually beating the market by 1.2%. And again, that may not seem like a lot, but over the long term, that's huge. Now, we do like to see clubs getting in that 3%, 4%, 5% range, and the ones that do that are over the long term are just have spectacular results. But again, part of the goal is to aim for putting ourselves in position to outperform, and our ladies of northwestern Indiana have done that. So again, there's an Ethernet standing ovation going on right now, and let's dig in and see how they do it a little bit. But I did want to spend just a moment talking about, again, these senior communities, and then also the Beardstown ladies. We spent just a year ago with Dashboard Diagnostics. You can actually go to the Manifest forum and go back and look at that discussion. And it was back in that time frame that we discovered that the Beardstown ladies are taking on new members. They've actually grown in size over the last few years, and they're also dabbling with using covered calls, conservative option strategy. So they're never stopping learning, and they don't plan to slow down anytime soon. So again, that promises kept message is such a powerful one. And one of the reasons I wanted to bring it up is it just reminded me of we've been doing some work with the Motley Fool here lately, and I was reminded of everybody. I think many of the people in the room remember that there was controversy surrounding the Beardstown ladies a few years ago, and we had Tom Gardner in town in Chicago for a program shortly after that controversy broke out. And this was Tom's message to a group of about 400 people in Chicago at that time, where he basically talked about, not just the ladies, but certainly as the kind of the poster child for the modern investment club movement, the ladies, speaking of the Beardstown ladies specifically, they really did inspire a generation of American investors to learn about long-term investing. And he just took his hat off to the ladies, and I just wanted to point out that that was really a cool moment. So let's go ahead and talk about our ladies for tonight. Here is the dashboard view that we basically talk about any portfolio. We're going to look at the portfolio in a few minutes, but I wanted to focus in on the report card, the so-called report card that we use.
Mark, just one thing.
Yep, go ahead.
They're not all ladies.
Oh, they're not?
No.
Oh, okay. Well, strike those thoughts. Sorry, guys.
Apparently it's mostly ladies.
Well, yeah, it sounds like it was mostly ladies, but sorry about that. Well, it's a mixed club. Better yet, that means they're not chauvinists. Well, good. All right. So again, the Northwestern Indiana Club. This is a look at their portfolio, and men and women apparently. And here's the section on our dashboards, which we referred to as the report card. And again, we want to focus in on three major characteristics. There's several things that we keep track of, but these top three are the major ones. And the first is, what is the overall projected annual return of the portfolio? And you can see here it's 11.7. Why do we want to know that? Because we basically want to be always keeping track and comparing where we're at versus what is the average stock. Well, how do we know that? Well, we actually provide the average stock right now. It's actually the median stock is at 7.2%. So we've got something to give us a relative comparison. And the stocks in the club's portfolio are actually 4.5 percentage points higher than the average stock in the market. So pretty good. So that's what you see over here. That we'd like for it to be, 5 to 10 percentage points. That's this target range that you see here. But you can see that they're close. So again, as they think about the portfolio, what they want to be doing is just looking for opportunities where they can raise their overall projected return forecast just a smidge, just a little bit. Second, one of the more powerful characteristics, again, is quality, and this is 72.2. That means that the average company, again, the overall average for the portfolio, is still in the excellent range at 72.2. What we generally recommend is that the clubs basically reach for 75, give or take a little bit either way, and that's what you see with this target range. So again, that's based on our observations of club portfolios going back over 20 years now of clubs that seem to succeed. And again, having a overall high quality rating is going to protect your club or your individual personal portfolio during corrections and recessions, and just basically keep it strong with the strong, by the best, by the leadership companies, and they certainly have quite a few in the portfolio. Third, and this might be one of the most important factors of all, make sure that you have a mix of small and medium and large companies in your portfolio. And we really want to aim for something in that 11% range, give or take. And again, this is the target range that we're depicting here. Again, these two target ranges never move. The one up at the top, this one actually moves with the market up and down. These two don't change. The quality, we always want to keep at 75, give or take. The overall sales growth of the portfolio, the sales growth forecast, we want it to be, again, 11%, give or take a percent or two. So in this case, they're kind of at the low end of where we'd want to be. So again, as we talk about the portfolio and we keep eyes open for opportunity, we want to look for opportunities to identify higher growth companies. Those are generally going to be smaller companies to add to the mix, maybe cut back a little bit on some of the larger ones, and basically take care of those three options. So our mission with this portfolio, again, will be try to raise the return a little bit, don't mess up the quality, if possible, improve it, and then also find some smaller and medium-sized companies in order to boost the overall average sales growth. So all in all, pretty good shape. They're really close. The club is really close on all those marks. Now the PE ratio is very typical in the mid-teens, nothing wrong with that. A very typical yield at about 1.5%, and then they also have considerable financial strength. That would be somewhere between an A and an A+ rating, translating it into value line speak. And with an EPS stability rating of 75, most of the companies in the portfolio, over on average, are relatively straight historical trends. And we'll see that as we look at a couple. They do have a couple that are a little bit bouncy that drags that number down a little bit. But again, if you're out there searching for companies that are very consistent through economic cycles, and we certainly went through a heck of an economic speed bump here about 3 to 4 years ago, some of those companies actually just step right through that without too much damage during the recession and the correction that comes with it. Let's start by taking a look at that growth element of the portfolio. Again, we want to make sure that we have a mix of small, medium, and large. The recommendation is to have basically a quarter of the portfolio, or 25%, in what would be deemed smaller companies. We tend to think of them as faster growing at Manifest Investing. Anything that has a growth rate of more than 12% we deem to be a small company. And then you also want to have 25% of your portfolio in larger companies, so they've got a little bit strong on that. Not too bad. Again, these are both nice slices of the pie. We deem any company that has a growth forecast less than 7 to be large, deemed at large. And then, of course, everything in between are the medium-sized companies. You want about half of your portfolio here. This is where some of the more promising core companies can come from. But those are going to be companies growing between 7 and 12%. Again, it represents the vast part of the population of companies out there. So you want to be shopping amongst all of the above. And we make that point here with this quick graphic that looks over the last 10 years. If you happen to be either an individual investor or in an investment club where you're having trouble convincing your partners that it really does make sense to invest in small, medium, and large companies, pull this chart out. This is one you almost ought to carry in your back pocket if you ever run into resistance, because what this graph shows you, the S&P 500 is basically an index of 500 very large companies. These are all large companies. And you can see when people talk about the lost decade, they're basically talking about this, where the decade started 10 years ago and basically is in the same place that it was 10 years ago. That flat spot is often referred to as the lost decade. Well, during that same period of time, the group of companies represented by the value line arithmetic average. Now, again, that's 1,700 companies. And oh, by the way, all of these are in there. Those 500 companies are in the value line arithmetic average, but what the 1,700 companies also include are quite a few in fact, medium-sized companies, and quite a few, more than you would expect, smaller companies to make up the 1,700. So we refer to the value line arithmetic average as kind of a really cool all of the above thing to track. And the thing we want to notice here is this right here. Over the 10-year period where the S&P 500, the large companies basically got stuck in the mud and went absolutely nowhere, if you had been investing in small, medium, and large companies, the opportunities or the potential or the probability that you might have experienced some of this comes to life. It's one of the most important aspects of portfolio design that we encourage and emphasize at Manifest Investing. So again, you want all of the above. You want some small, some medium, and some large. And again, the way we gauge that is to look at the overall sales growth forecast of the portfolio, shoot for 11%, give or take. How about the club's sector diversification? Actually looks pretty good. You don't have to have all 10 sectors, as sectors are defined by either S&P or Morningstar. You can skip a sector if you want, sector or two, but you do want to kind of spread things out. Certainly nothing wrong with any of these. Maybe a little bit of a concentration in industrials, a little bit of strength there. They probably have had some considerable success with a couple of their selections. We'll be looking at those in a second. If there is one sector that maybe is getting a little bit heavy in the portfolio, it would be healthcare at 39.6. I don't think that's anything to panic about yet, but if it were mine, if they basically turn the portfolio over, said, Mark, it's yours, take care of it as if it were your own, I certainly would not be aggressively shopping in the healthcare sector, and I would be watching for opportunities to perhaps, whittle that down over time also, shopping in some of the other sectors. Any questions on the board or any hands in the air at this point, Lori?
I don't see any.
Okay. People, questions are welcome as we go, so feel free to jump in at any time you feel that you need to. Well, here's a look at the portfolio. It's a solid portfolio, obviously influenced by the community. I know that some of the ladies attend some of our events. I know Jeannie, who happens to be down in Costa Rica, has attended many of our events, and there you can see that there's probably a little bit of influence there, if not quite a bit of influence. Some really good companies in the portfolio, ranging from True Religion, which I don't understand, but I just don't understand. You could never sell me a $400 pair of jeans, but some people apparently buy them. Teva Pharmaceutical, Cisco, these are all top-notch companies. It's always nice to see companies like this in a portfolio. Neogen, for those of you that are not familiar with the company, is a company in food safety. They actually got their start at Michigan State as in their incubator at the university, literally having to do with keeping dairy and cattle, dairy cows clean in the dairy production process. That's how they got their start, and they're now a food safety, food monitoring company. And we might even take a look at them. I don't have them on the program yet, but we might even take a look because they're a perfect example of the type of company that can be still relatively small, but still demonstrate all the strong management characteristics of consistency and profitability over time. And the other reason that we like them is they like us. They spend time with investment clubs and at some of the events in the Michigan area, down into Ohio a little bit, but they are willing to come out and talk with retail investors and tell the Neogen story. So we obviously like that. Some other household names in the portfolio, quite a few across the board. We don't use the F word here in our house because my wife works for Chrysler, but that actually is a company that's done fairly well here in the last several months. And then Caterpillar, again, out of Peoria, Illinois, good Midwestern company that does represent 19% of the portfolio. So that is an example of one that has gotten up there a little bit in portfolio size. Again, nothing to panic over yet, but I would be, if it were mine, I would be watching for opportunities to perhaps replace either all or part of Caterpillar, the Caterpillar stake, with other companies. The other reason that you might want to do that is what you see over here. This column has been sorted using the dashboards at Manifest by clicking on the projected annual return column header, sorted from highest to lowest. So again, as we look at portfolios, the buying opportunities are at the top. The buying opportunities are up here. Potential opportunities to accumulate stocks. And again, some of these are getting a little bit high in terms of percent of total assets. That's also something you have to think about. There's a couple there that are only 6%. Intel could be interesting to kick around as a potential accumulation for the club, still in the sweet spot over here. And then the ones at the bottom, if you're trying to improve the portfolio, if you're looking for proceeds to fund a withdrawal or whatever, these are the ones down here that are going to be the potential selling candidates. And we can see that Caterpillar actually ranks the lowest. In many investment clubs, they actually have a standard operating procedure where Caterpillar, during a club meeting, would be opened for debate and literally be challenged as to whether or not it still is bringing everything to the portfolio that it should going forward. And keep in mind, we're not talking about whether or not it's been a good stock in the portfolio. I would be willing to bet that they paid much less for Caterpillar and that it's actually been a very strong performer, perhaps as much as doubling in price since they bought it. And I don't know the details of that, but again, as you're looking at a portfolio and thinking about it in the context that we're looking at tonight, I really don't care, except when it comes to tax consequences. What we really want to look at is what are the expectations and the potential of the company going forward. And you can see that run up in price, it's actually up to 113. I didn't realize that. It's basically driven down the return forecast down into mid-single digits. So no matter how good the company is, it can become a candidate for sale as that number approaches 0. Second one up on the list is Ford, and that's kind of a special condition. We're going to talk about it. It's not the highest quality company, and could be an interesting opportunity to take a closer look at that one also. Any comments on the portfolio or questions at this point, Lori?
Yeah, Herb Limpel is asking if would you think Caterpillar would be a candidate for a trailing stop loss order?
I actually think it would be. I mean, it could be even for those clubs that are pursuing the covered call thing. It could be that, depending on what it looks like. You know, Caterpillar is an example of a company. We'll take a look at the price chart here in a minute, where if a correction comes, and it is at a low projected annual return, as it is over here on the right, it is vulnerable to a fairly nasty or a fairly deep price correction. So what Herb is recommending is that that investment clubs and individual investors understand the concept of a trailing stop loss. The place where we find the most application for a trailing stop loss order is it's just basically a form of protection, and I'm not going to go too deep into it now, but it's a form of protection that basically ratchets up and follows the stock price up and has a programmed sell limit. Actually, True Religion Apparel would be an example of a Roman candle. I tend to refer to them as Roman candle type stocks that when they take off and they fly like a Roman candle, you can actually use this trailing stop limit to set a selling point that actually follows it up on the ascent. And we have people in the groundhog contest for this year that are thinking about putting trailing stops on Buffalo Wild Wings right now because of the way Buffalo Wild Wings has behaved here in the last few days and months and years. Any other questions?
Yeah, Marty is asking that they seem to have a minimal number of stocks relative to having 23 members, so he was wondering if that's good or not.
Well, that's an interesting question. Maybe that's something that Gene can help us with. Typically, an investment club of this size, we would recommend that the club have 16-ish, plus or minus 4 stocks in the portfolio. And in fact, as I go into looking at the portfolio and what I would do with it, if it were mine, what I would begin doing over time is like take the Caterpillar position and probably divide it into 3 pieces with replacements. That's what we're going to do here in a minute. And again, if it were mine, I would probably try to move it to a position where I have at least 12 and probably target 16 and then just kind of float around that 16 level. And that gives you a better opportunity to make sure that you are sector diversified, but you can also you can have a little bit more fun perhaps with some what you might call a junior position in stocks. We're going to talk a little bit about one of their neighboring companies here in a few minutes that could be a junior position candidate. Anything else?
Not for now.
Okay, let's press on, and then let's think about Caterpillar in terms of that challenge stock situation. Just as a quick reminder, this is what we do in our community of investors. This is what we do. We basically try to visualize, what this company will look like, and we try to build an understanding of the company, the business model itself, where we take a look at the history over on this side and combine that with some expectations. That's what this yellow area is here, some expectations, and we basically build a long-term trend for the company, and that's what's shown right here, this long-term trend shown by the red line. So for the top line, in the case of all industrial companies, that's going to be the revenues or sales. We're trying to build an understanding of how the company behaves over time, perhaps against recessions, that sort of thing, but through economic cycles. And what we really care about the most is the general characteristics of that longer-term trend. And then we also compare the difference between the top and the bottom line being the earnings per share, the profitability of the company. The difference between those two lines is literally the profit margin, the profitability of the company. So as they get closer together, as the profitability gets higher, as the net profit margins get higher, but you can see that that it actually has been an improving margin situation in the case of this model company. And we basically try to build this picture of, well, what might this company look like 5 years out? We always use a 5-year time horizon, and we build the earnings forecast out here, especially for our core type companies. So let's talk about Caterpillar. This would be the potential challenge stock within the portfolio. This is using the software where we can actually take a look at the historical profile of the company. And what you can see here is the recession, which has come to be known as the Great Recession. You can see what happened to many companies, including the heavy capital equipment suppliers like Caterpillar. It took quite a hit. The top line even took quite a hit, dropped down significantly as that recession raged on, and then has recovered here in the last couple of years. These 2 years, again, 2012 and 2013, are forecasts. So these 2 points that you see out here for both the sales and for the earnings are analyst consensus forecasts for the company. So you can see that the analysts are pretty bullish on fundamental expectations for Caterpillar going forward. The long-term trend for Caterpillar, even with this significant trough in here, is still on the order of 9%. If you take a look at published estimates, you're going to find published estimates generally in that 8 to 11% range for the sales growth forecast, where you can find them. There aren't too many places where you can find them, but you can certainly understand why somebody would look at this company and expect a growth rate of something like upper single digits. As is often the case during a corrective moment or a recessionary period, the earnings actually suffer worse just because of business model characteristics. And you can see that definitely the stock price, it generally always does, follows the earnings down. So the economic pressures that were in place there caused earnings to drop pretty far down. Didn't drop off the page, as we're going to see with Ford here in a minute, but it stayed on the page. But it took quite a hit during that recession. But again, over the long term, what we really care about is, what does the long-term trend look like, coming right through the middle of all this data. And we would absolutely expect at some point here in the future for these earnings numbers to come back here in some way. Don't know when, don't know how, but it would be absolutely normal for them to cycle back towards that trend line. And the same thing will be true up here for sales. At some point, they're going to cycle back a little bit. Now, Caterpillar has some fascinating opportunities on the international scene too, and that's where a lot of this corrective action here has been. A lot of the stuff that they're doing in the Far East, and just some of the newer products and things that they're coming out with are on the energy side of things and everything else. This is a well-managed company. Nothing wrong with it. But our takeaway is it's a company apparently positioned to grow at 9% with some sensitivity to recessions. One of the other things that we recommend when you're looking at your companies and you're doing your stock studies is to use a fairly powerful second opinion known as value line. And that's what this low total return forecast is here. And you want to basically be looking at that and comparing it to your studies, to the work that you see coming out of the research at Manifest Investing. And we see a forecast of 11% for Caterpillar. We're going to come back and talk about that in a minute because it's a little bit different than ours. But it's I would say, from my experience looking at a lot of these numbers every day, 98% of the time, maybe 96% of the time, that's usually going to be pretty close to the zone you want to be in with your relative forecast. So if you get to the bottom of your stock selection guide and you're dramatically different than that number, you want to dig a little bit deeper and understand what is causing that difference. It's a nice second check on any company to compare the results of your stock study. And again, the result being the projected return at the end of your stock study. Here's a look at the profitability for Caterpillar, and again, we're using net margin, so that these are after-tax numbers. And you can see, obviously, the impact of the recession here. Pretty deep dive. Didn't go zero or sub-zero, but it took a pretty good hit. Normal thing for this type of company. And you can see that the analyst expectations for 2012, 2013 are pretty strong. So it's basically coming back into a fairly normal historical range, somewhere in that 7 to 8% range going forward. And in fact, if you look out in the value line forecast out to 3 to 5 years, they're actually quite ambitious about it. But I would be comfortable thinking about this company in terms of a 7 or 8% forecasted net margin going forward, kind of an average condition going forward. Here's what it looks like in the Equity Analysis Guide summary at Manifest Investing. And again, this is the place where you can come and check the results of your own study to see, basically what do the analysts think and what does that come out to be. And you can see that the analysts actually, when you factor them all in, are even a little bit stronger than what you saw on that visual analysis a few minutes ago, somewhere in the 10% range for growth expectations. And then you can see that we have a 7.4 net margin forecast, and again, that's based on analyst expectations. And this is the area that explains why that number on the preceding slide, this 11%, why that is so high. And here it is right here. Basically taking a look, and we take a look across a cross-section of Morningstar, Value Line, Standard & Poor's, obviously the guide that you were just looking at, and we came up with a lower number. And if you actually jump to the specifics of what Value Line is looking at, here's the history going back to 2001, and you can see that the numbers have been steadily improving. You can see that these were basically the numbers that were on that preceding picture. But take a look at this number right here. I don't know if that's possible or not. It's certainly unprecedented with Caterpillar. That's basically a 50% gain in operating margins or net profit margins from where they're at today. And that's not easy to do. They may have some strategy that, after you dug in and understood it, that you might be able to convince yourself that this 11.2% was feasible. But this 11.2% that you see here on the Value Line forecast is the only way you can get to an 11% return, because RPE is about the same at 13. So again, the growth rate's roughly the same, the PE is roughly the same, our expected profitability. And again, Morningstar and Standard & Poor's would agree with us, is not quite as ambitious as what you see down here. And that's why I would be more inclined to believe a 5% or 6% number versus the Value Line number that you saw on the preceding slide, that 11%. And again, this is a fairly unusual or unique difference, especially for a company like this. So, but the 11.2% 3 to 5 year forecast from Value Line explains the difference in the forecasts. And you guys all out there can decide. Maybe somebody within the club studies Caterpillar in more detail and has a higher confidence level in that 11. I don't, without doing a little bit deeper study. And it would take a lot to get there. Any questions at this point, Lori?
Somebody just asked if the club would consider replacing Caterpillar with a growth stock, and they suggested Apple.
Okay. Well, I would argue, first of all, be careful with throwing around that slanderous expression growth stock. This is a growth stock. It's got a 10% growth rate. So if you're thinking it's not a growth stock, it is a growth stock. It's a 10% growth stock. Apple's a little higher. I agree with that, but it's a higher growth stock.
Yeah, 10% is
okay.
Good.
Let's come back and talk. Well, now we're going to talk about a company that's not necessarily a growth stock. Just wanted to take a quick look at what I would consider to be a non-core or a special situation holding within the portfolio. And it's not because we're allergic to the F word in this house. We drive Chryslers, and my wife works there. But Ford is it's a fascinating company. They've had a real nice run over here over the last few years. They're obviously famous for not needing any of the bailout situation. Their earnings have been fairly strong for the last year. They're projected to be fairly strong for next year. You can see that the analyst expectations, and I think these are a little bit frothy also, much like the Caterpillar situation, but a 16% return for Ford. So if you're a stock watcher in your club following Ford, that's a number that I would certainly be watching and engaging against studies. This is not a growth company. This is a company that actually has a negative growth over the historical range, and then perhaps if you just focus in on the modern Ford from here going forward, you might be looking at a 2 or 3% growth rate going forward, and that would be really ambitious. But the real telling thing about Ford is this period where for several years earnings went negative, and it makes it very hard to study using traditional measures, using the traditional stock study methods that we use. In fact, many for a club of beginners, we would say, run screaming from the, run for the hills with this one. This is anything but up straight and parallel, right? So that automatically makes it a non-core stock. That doesn't mean that there are not investing opportunities. For experienced investors who know what they're doing and perhaps have a little bit of a speculative or risk capital mode, I know there's probably people in this room that bought Ford stock between $1 and $2 back in this time frame. And they literally, and in fact, many of them, in fact, my good friend, Mr. Kavula, sold some right up here. It had literally gone up, I believe, 800 or 900% from the time he had purchased it. But even he knows sometimes it's time to take it off the table, and he would have been looking at this number as one of the things guiding him to do that. So again, this is a special situation. I would watch it carefully. I would watch for opportunities to perhaps sell it, because over the lifetime of Ford, you're going to get buying and selling opportunities. It's the type of company that you should be willing to buy and sell as required and be opportunistic about it. And again, it's not a situation where we would recommend that beginners pursue it at all. All right, so what I thought I would do is we can actually do this live, but we're going to actually work through a worksheet situation with our dashboards. I'll actually go and show this here in a minute, but what you see here is the display where we call it the sandbox. You can actually play what-if games with the portfolio.
Hey, Mark, before you go on, somebody's asking for you to talk about what you mean by non-core and core. They said, are you saying that means a stock that has less of a growth potential?
Well, non-core is basically everything that's not core. How's that for deep? The stocks that we typically study, and the vast majority of stocks in this particular portfolio, are what most of us would consider to be core holdings. Your Johnson & Johnsons, your Cisco Systems. What's going to characterize most times a quality company for most of us is going to be a combination of some type of a combination of high quality, high financial strength, and high earnings per share stability. When you've got those things in some measure, it's going to be, again, they come in various flavors, but most core stocks, core holdings are going to have those type of things. So take for example, Johnson & Johnson, excellent quality rating, and then almost unbeatable financial strength and straight lines on the guide. So that's going to be core. Varian most likely is going to be core. So again, it's kind of in the eye of the beholder, but it's kind of a function of how you think about those three things. You can see that Ford doesn't fit that description very well at all. It's a very unstable situation. It doesn't mean that there isn't an investment opportunity, and it does not even for a heartbeat, mean that they're bad people. I mean, I live next door to Ford people. They're great people. It's just the characteristic of the company and the industry that they're in, and how it responds to the economy.
You live in a mixed neighborhood, huh, Mark?
I live in a very mixed neighborhood. We've got
Chrysler right next to Ford.
Oh, when we moved into the Detroit area about 13 or 14 years ago, I was driving a non-Detroit car.
Oh, that's a
We'll
bad
just leave
thing
it at
in
that.
Michigan. Yeah.
I'll tell you that one of my neighbors came over one day and he says, "We're going to give you 6 or 12 months, Mark, but if you don't sell that thing, we're going to come over and set the tires on fire." And I looked at him and I expected to see some type of a smile or a wink. And I think he was serious. So yeah, we do kind of take it personal around here.
I know. I drove a Volkswagen when I got hired by Oldsmobile from college. People used to come up to me and go, "We know which car yours is in the parking lot."
Well, my wife used to drive a Honda minivan, and when she goes to work at Chrysler, they make her park like 14 football fields away because they don't allow the non-Chrysler cars close to the building. So there are advantages. Anyhow, hopefully that'll help. What George Nicholson referred to as a non-core holding was the type of stocks that were very economically sensitive. You could even make a case that Neogen could be treated as a non-core stock because it's so small and so relatively new. Doesn't have quite the track record. Many times people within our community, anytime the company's not in the value line standard edition, that's what that little star or asterisk means on Neogen. It's kind of automatically, in some people's opinion, treated as a non-core company. Now, why does that matter? And we're just kind of taking a step back from this just to talk about a little bit of just common sense, prudent thinking to the way I think. We really should think about the buying and selling of core companies differently than non-core companies. Fair enough? You know, for a Johnson & Johnson, you should be trying to buy it at a not necessarily quite as high a projected return, and you would basically hang on to it until the return got down to basically almost zero under today's conditions. It's nowhere near that right now. So a core holding, we basically wouldn't even be thinking about selling it at all unless the portfolio really needed it, and this one doesn't, until the returns for an individual stock got down into zero. For a non-core holding like Ford, for example, or perhaps even True Religion Apparel, although that's got pretty strong characteristics, I'd be willing to sell that at a higher return forecast. In other words, if that got down into that 7 to 10 range, and I thought of it as a non-core, I might be a little bit more willing to pull the selling trigger on it. And Ford is definitely should be treated as a non-core. So again, it could be stocks that are more cyclical. Again, Nicholson did not say don't invest in cyclicals. He said don't invest in them unless you know what you're doing and have some experience as an investor. So again, that's one of the categories would be one of the non-core categories would be the cyclical stocks. So anyhow, let's take a look at, in this case, what I have done is I've actually used this little green thing to put Caterpillar down in a holding zone. And what you can see here is I took, the club has basically 23 people contributing probably about an average of $50. So I put a little bit of cash in the portfolio. And then I also, the program will also put the 8,500 up into this number. So we have $9,700 in cash, 20%, 21.5% of total assets. So we have some money to go shopping with in this case. So let's go ahead and go do some shopping. The first thing I did is I built a quick screen where, first of all, I avoided healthcare. As you look down here at the sectors, you won't find the healthcare sector in there. And I basically said, let's look for stocks that are between, 5 to 10 percentage points above the median stock or the average stock out there. That's what the sweet spot is. So we're looking for stocks between 12 and 17% return. 65 is the cutoff for quality, so we want stocks that are greater than 65. 70 is like a B++ value line rating for a stock, so we want them to be B++ or better. And again, we want a little bit of growth, so let's check in with at least 10% on this one. And we like those straight lines, so 75. You hit return and you get this relatively short list of stocks. And you can go down it from top to bottom and perhaps look for something that might resonate. In this case, I see a number of stocks that have been kicked around in the community. I'll point everybody to this one right now because it is showing up on a number of groundhog portfolios that are entering the contest. AeroVironment, I really don't know much at all about what they do. Ticker symbol AVAV, that you might want to study up on that one. Again, many of your community colleagues are drawn to that one. Ritchie Brothers, this is worth looking into too. They have some of the same economic drivers that Caterpillar would have. They're basically a reselling auctioneer of heavy equipment, and they're doing a lot of work in the Far East and China, Indonesia, in those areas. So they basically move heavy equipment around to where the infrastructure projects are at. Speaking of infrastructure projects, here's two companies that design them. Basically do the design work, and we have featured both of those companies at Manifest, so you can take a look. C.H. Robinson, a very highly thought of trucking company, logistics company. Tim Hortons, and a couple other community favorites here, all good. I'm going to draw our attention to this one though. Waste Connections, just to demonstrate something that you can do at Manifest. This is a company that was featured by Ken Kabula in the roundtable a few months ago, and it's done very well. And he basically told a real nice story about the company back during the roundtable session. And you can actually retrieve that online. And what I'd like to do is jump out of the presentation and demonstrate how that might be done. So let me jump out of the PowerPoint here, jump over to our website. I'm going to actually go to, why don't I just demonstrate that search real quick. I'll do a stock search where we basically put in every sector except for healthcare. We might get a slightly different list because I prepared the slide before the market closed. Let's use the sweet spot. Again, that's going to be between 12 and 17. Quality rating of 65, financial strength rating of 70 to stay at B+, 10 for a growth rating, EPS stability in the top 25% of all companies. And we've got other things we could sort on, but that's going to be enough. And I suspect that Waste Connections will still be in there. That list might be a tiny bit different, but it looks pretty much the same. And here's Waste Connections. So you can actually jump over to Waste Connections, actually go to the Equity Analysis Guide page, and what I'm going to show you here is click on this little magnifying glass on the Equity Analysis Guide page, and that takes you to articles and forum posts where the subject or the company, Waste Connections, was talked about. You can actually dive right in to the presentation. This is back from March. It's a little bit dated, but as part of that presentation, again, if you were making a presentation to your club or if you're the stock watcher and might be following Waste Connections, you can actually click on it and be taken to the YouTube. This might take a second to come up. To the YouTube presentation put on by Ken, where he actually went through a fairly detailed discussion of the company and what he saw. So again, you can go to that presentation. We're not going to spend any time on it, but you can. Okay. So that's just kind of a neat thing to kind of tinker with. Go to the Equity Analysis Guide, click on that thing, and explore what you might be able to find for companies. I did a second search where all I did is I went in and searched on manifest rank greater than 99.4. And what that basically gives you is the top 0.5% and 1% of all companies based on a combination of the quality rating and the projected annual return. We basically take the two, score them, and basically build a rank where these are some of the more interesting companies that we would find. So again, if I'm in this club or I'm trying to figure out if they give it to me and what I would do with it, these are two things that I would look at. I would look at that Waste Connections perhaps, and then I would be really intrigued by all of these up here, and it actually kind of scares me that they're all up at the top because they're not all going to win. But look at the opportunities in software consulting. We featured this one, Infosys Tech, fairly recently. So just some things to look at. BioReference Labs. This one I'm going to bring up because I know it resonates with a lot of the members of our audience, and it's a company headquartered not too far from where this club operates. The Vera Bradley world headquarters are near Fort Wayne, Indiana, and they just make, again, one of those companies I don't understand it, but they make all kinds of handbags and purses and luggage and all kinds of stuff. You can't even imagine. Toothbrush holders, and if you ever get a chance to stop in and check them out, I would recommend that. Now this screen actually left the healthcare companies in here, so you see BioReference Labs, Masimo, company worthy of study. But again, remember we said that this company doesn't need more healthcare. Stryker, great company, they don't need more healthcare though. So some interesting companies on here. I would focus in on Infosys Technology and Vera Bradley. We'll use those for the purposes of demonstration here tonight. And I would literally,
Mark,
go ahead.
Sorry. Ellen was just wondering how you came up with that screen, the search criteria.
Okay, let's go ahead and demonstrate that too then. It's a good point. It's my absolute favorite screen to use. If you jump back over to Manifest Investing, and you go into stock search, if you go down to manifest rank, you only have to enter one number. Enter 99.4 and hit search. And then again, that's going to deliver about a dozen, maybe 15 companies. Well, I guess it's actually 16 companies that are attractive for study. And again, it could be a tiny bit different from what we saw a few minutes ago because of any changes in the market today, but it's largely the same. So again, 99.4 or 99.5. You could even do, if you want a really short list, 99.7. There's a really short list of companies. And again, some of these are a little bit high out of the sweet spot, meaning that they're more than 10 percentage points higher than the average stock. So again, be extra careful with them. But the fact that these have such high quality ratings means that you're probably not on too thin ice. If they didn't have the high quality ratings, I would start getting more nervous the higher those numbers go, because we know they basically become too good to be true at some point. All right, so I would basically come back to the portfolio, and again, we can demonstrate this in a second if we have a little bit of extra time, but you can, I've inserted 100 shares of Waste Connections, I've inserted 75 shares of Infosys Technology, and 50 shares of Vera Bradley, just to see what it would do to the portfolio, and actually had some pretty good effect on the portfolio overall. And what I thought I would do is just grab that report card that we started the session at. We started with a projected annual return, and what we said is we'd like to find some higher return candidates that fit well within the portfolio. And you can see that we started at 11.7 and improved it overall to 14.1. We still have a little bit of cash left, but not a whole lot. You can see that the quality started at 72.2, and our mission was to don't disturb that. If anything, improve it a little bit. And you can see that after those changes were made, the quality rating is up to 76, and again, that's in a very nice zone. And again, the one that we really wanted to give some TLC to was this overall sales growth forecast for the portfolio, and you can see that that has also been raised to 10.3. So again, that's now getting up and nibbling closer to that 11% give or take range. So the changes that were made, if the club came to be comfortable with those three companies, have the right influence or impact on the portfolio. So that's kind of the before and after situation, the way we like you to think of it. And we can open things up for questions. And I'm going to leave it with Gene Hackman, our basketball coach, and Barbara Hershey for Valentine's Day. And just say happy Hoosier Valentine's Day to everybody, and we'll open the floor up for questions. Anybody have any comments or questions?
Well, Don Lenos says AVAV is drone missiles for the military, apparently.
AVAV does what kind of missiles?
Drones.
Oh, the drone missiles. Okay. Well, we appear to be using a few of those here lately.
And Marty Eggerly liked your non-core explanation. Thought it was a very visual way to think about it.
Well, we're trying to figure out how to answer that question. As you know, Marty, it really is in the eye of the beholder. And we'll just keep scratching away at it. What I thought I might demonstrate for the group is the actual worksheet process, or the thing we call the sandbox, because I think a lot of you have not necessarily seen this, or you just like to see this kind of tinkered with. You can take any dashboard that you have, and you can only operate with one worksheet running in the background at any one time. But if you take that portfolio and you copy to a worksheet, what you are given is and you can see I played with this one earlier today, and you can see that it's actually been restored to the original condition. All of the original companies are in here, and you can basically play what-if games in it without disturbing the original portfolio. Other clubs actually use this to do precisely what we just did, to develop a proposal of what if we sell company A and replace it with companies B and C, and what does that actually do to the portfolio. So they'll prepare an actual proposal to the investment club showing the effect of the proposed selling and buying transactions. The way that you use it, again, much as we did, we saw if you sort it by the projected annual return and begin looking at the portfolio, again, we saw that Caterpillar, price must have gone up a little bit today. This is down actually 0.1%. The Caterpillar, we actually just set that aside. And we maybe didn't want to get rid of it completely, but we set it aside, put it down here, and it's in the holding period, holding zone. Whoa, excuse me. Okay, and these pie charts actually correct on the fly. So as you do that, they actually will correct. We did put a little bit of cash in the portfolio just to make that point. You can actually just make the changes, inject that in, and then we could ask the question, well, what if we used AV instead as the stock, the drone missile company instead? Let's go ahead and put that in the portfolio. It's now going in there without any shares, so we can see the stock price and we can look at the characteristics. Looks pretty good to me. So we could have just as easily said, well, what if we bought 100 shares of AeroVironment? And you can see that's $2,800 worth of stock. Took it out of cash, and again, we actually improved the portfolio a little bit by doing that. Let's put those 75 shares of Infosys Technology in just to make the point. And you can see we're down to 5% cash. We've already brought the portfolio back into the sweet spot, and everything is headed in the right direction. So again, you can play those type of what-if games. And you can see that the transactions that we've made boosted the technology a little bit. Industrials is down a little bit. How are we doing on the size thing? Well, we actually bought a small company, so we're a little concentrated in the small here with the transactions that we have just done. We bought rapidly growing companies, so we basically now have room for, I would probably be out there emphasizing the companies between 7 and 12% growth now, the medium-sized companies, for the next portfolio transaction, or the what-if that we're doing here. Any other questions or comments?
Well, it's a quiet crowd tonight.
Just a bunch of sweethearts.
Yep.
All right, if there aren't any questions, we'll go ahead and bring it to an official close. Lori and I will stick around for a few minutes in case you have any unofficial questions. But again, hopefully you enjoyed the session. I just want to thank the club from Northwestern Indiana for participating. Super job so far, guys. Just keep up the good work. And we look forward to seeing all of you back here at the next Dashboard Diagnostics session in about a month. And we also have a Challenge Club meeting coming up a week from today. And 2 Mondays from now, the next roundtable session. So with that, we'll stay on board. But